Ever pay sale prices and still feel ripped off? That's the stock market right now. Looks shiny, costs a lot, quality varies. Tonight I'll show you, without math class pain, how prices ran ahead of value, what the Fed's latest move really means, and a simple plan to keep growing your money without chasing hype. I'm not here to scare you. I'm here to make this easy. I build systems that remove guesswork. No crystal balls, just rules that help regular people win over time. By the end, you'll know how to keep compounding, even when the market is acting like it's on an energy drink. Now here's the thing about expensive markets, and this might surprise you. Is it expensive? Think lemonade stand. Imagine a lemonade stand that earns $10 a day. Would you pay $100 for that business? Sure. Would you pay $300? Maybe. Would you pay $10,000? Where are the gold bars that come with it, right? That's the market today. Wonderful stands with soaring price tags. But how do we know for sure? I've got 3 dead simple tests, no PhD required. 3 quick checks. 1. The house test. If house prices zoom faster than rent, it's probably not a great deal. Stock prices have zoomed faster than the profits you rent as an owner. 2. The grocery cart test. You're paying more per item than usual. Same cereal, bigger bill. Many stocks cost more per dollar of sales than ever. Great cereal, sure, but you're paying top shelf prices. 3. The rubber band test. When a rubber band stretches too far, it snaps back a bit. With stocks, when prices stretch way ahead of value, the next 5 to 10 years often snap back to average, meaning lower returns. Not doom, just less juice. The signals don't time crashes. They do tell you to keep your cool and watch your entry price. Speaking of signals, the Fed just sent us a mixed one. I call it taking your foot off the brake while letting air out of the tires. The Fed cut interest rates a bit. That's like taking your foot slightly off the brake. Cheaper loans, a little more speed. But the Fed is still doing QT, quantitative tightening, which is like letting air out of the tires while you drive. You can still move, but not as fast and not as smooth. Rate cuts can give prices a sugar rush. QT quietly removes some of the easy money in the background. So if you're trying to beat the index while a few giant pricey stocks lead the parade, the Fed's tiny cut doesn't magically make that easy. But here's what gets people in trouble. They think high prices today automatically mean high returns tomorrow. Why high prices often mean lower future gains. Think of stock returns like a 3-layer sandwich. Starting yield, what the business is already earning for you. Growth, how much bigger it gets. And the mood later, what buyers are willing to pay for it in a few years. If you start by paying a high price, that first layer is thin. Even if growth is decent, the mood can turn from pay anything to I'm not paying that much. That mood shift alone can shrink your result. Not full-blown doom, just smaller long-run numbers. Now let me show you exactly what smart investors do when the market gets expensive. How to invest when things look pricey. 1. DCA, dollar cost averaging buy on a schedule. No hero moves. When prices dip, buy more shares. When they run hot, buy fewer. Slow and steady wins. 2. Great businesses at fair prices. Look for real cash flow, not just stories. Strong balance sheets, pricing power, and the company raise prices without losing customers, and a price tag that doesn't demand superhero growth to break even. 3. Don't crowd the crowded. If the market party is packed on the mega cap floor, peek at the other floors. Quality small and mid caps, places outside giants with single price tags, profits to you all.